get started, thank you for joining the webinar today. The title of it's Navigating the Industrial Frontier, CRE Trends in the Southwest. So for those of you that have joined and are not familiar with CompStak, so we are a free lease and sales comp database crowdsourced model. So we have over 30,000 CRE professionals, 750 properties, and 4 million comps submitted. Today we have two presenters, Michelle Gutierrez, who oversees GIS and research at NAI Horizon. Just a brief overview about NAI Horizon. So they're a full service commercial real estate company serving Arizona. NAI Horizon's part of the NAI Global commercial real estate network. So that network provides real estate solutions for nearly 400 offices worldwide. And then on the CompStak team, we have Ali Bauman presenting. So Ali is the director of real estate intelligence at CompStak, and they will be our two presenters. So if you have any questions, please send them in the chat box. We have time at the end of the webinar. We'll answer any of those questions. And we'll also send this presentation next week if you're registered for the webinar. So with that, I will hand it off to Michelle and Ali, and enjoy.
Great. Well, thank you, Sarah, and it's good to see you, Michelle, and thanks to everyone for joining. Just a quick overview of what we'll go over today. We're going to be covering the Southwest industrial markets, Las Vegas, Phoenix, and San Diego. We'll go through an overview of the industrial drivers for the Southwest market. We'll go over some leasing trends and rent growth. Then we'll turn to new construction trends and pipeline. And we'll also focus a little bit on manufacturing as part of the industrial sector with a focus on Phoenix. And finally, we'll end with what's next for Southwest industrial. What are some major headwinds or tailwinds for the market? So first, I'd like to talk about what is driving the growth in the Southwest industrial sector. So I will give this to Michelle. She has a few key thoughts about what is driving the growth in this region.
Hey everyone, so I would like to also give a shout out and thanks to my coworker, Noe Garcia, for helping with the research and preparation for this presentation as well. So here we're looking at the projected annual population growth as well as the median home value. So the land availability in and around the metro regions and the cost of living are the primary drivers of migration and population growth in Phoenix and Las Vegas. And in San Diego, along with Phoenix, the proximity to the ports of entry, both land and water, they're essential to the industrial market. And San Diego's major sectors like defense and military, international trade, manufacturing, it's creating a solid geographical region that's less prone to outward migration, unlike the Bay Area or Los Angeles. And so the projected population growth rate in the next 5 years in each county hovers around 2%, which is a positive indicator of continued developments. All right, so now we're going to look at the connectivity and the ports of entry. So Arizona borders the world's largest GDP economies, so California and Mexico. This enables the ease of movement of goods, people, and jobs. And with nearshoring in Mexico gaining momentum, the land port volumes are expected to increase quite a bit. And Phoenix is under 5 hours from the seaport of LA, straight shot drive on the Interstate 10, and you're there. San Diego, similar route along the Interstate 8. And then a major thoroughfare runs between Nogales, which is along the border, straight through Mexico, and then continues northwest towards Las Vegas. And then on the right-hand side, you can see the total TEUs graph. So Long Beach and LA's movement paced above the port of New York and New Jersey for the majority of 2023. And then industrial growth along the Mexico-US border has been expeditious this year. And so there's a strong correlation that can be made because of this. So I'm curious to see how the TEU numbers wrap up towards the end of Q4.
Yeah, I think that will be interesting as well, Michelle. So next we'll cover, what is the major driver of a lot of industrial growth in this region, as well as in the overall United States, especially over the last few years since the pandemic began and changed a lot of our lifestyles. So notably, recent data shows that e-commerce is actually still going up. It rose for the last 2 quarters, according to the most recent data from the United States Census. And while it's not quite up to its peak that it reached in 2020, right at the peak of COVID-19, it has been creeping up the last few quarters. It'll be interesting to see what happens as we enter the holiday season now that we're approaching, surprisingly, the end of 2023. Michelle, what is the overall retail sales data showing for the United States and for Arizona in particular on the right side chart?
Yeah, so the total US sales, retail sales in May 2023 were up 0.9% from May 2022 of last year. And this is the most recent data available on the census website. And looking back at these data, May 2023 is the first month this year we begin to see a positive year-over-year change. And it's projected that the tightening cycle, the decrease in interest rate hikes, is hopefully coming to an end. And census stat, along with the personal consumption expenditures, it's a tool for investors and it's a contributing indicator of the consumer price index. So it's indicated that more stable prices should allow occupiers to consider expansion and new leases that may otherwise not have been feasible when inflation was just on a roll and running rampant.
Absolutely. I think it will be very interesting to see, how inflation is trending and what the Federal Reserve does this week, I think today or tomorrow with interest rates. So
Okay.
next, yeah, Michelle.
Yeah, so the industrial leasing trends and rent growth are coming up next. And Allie, so what are we seeing as far as the leasing trends and rent growth in CompStak overall in the Southwest?
Great, thanks, Michelle. So according to CompStak's data, which we cover closed lease transactions, which is what is presented here, we've seen that starting rents have grown steadily from 2020 across these three markets, but rent growth has cooled a little bit in 2023 so far, with most growth occurring last year in 2022. But you can see in these charts since 2019, average industrial starting rents, meaning the base rent for the first year of industrial transactions, has had the fastest rate of growth in Las Vegas, but San Diego is still the most expensive market among these three different markets. And then since there's been so much rent growth in these markets, we can see the spread between what industrial tenants in place with active leases are paying today versus where starting rents for transactions that have been executed over the last 12 months and the spreads there. For example, in Phoenix, the spread between the current rents, which tenants are paying today, versus where our deals have been signed is 23%. And in San Diego, it's 16%, according to CompStak's data. We're also paying attention to how new construction and deliveries are impacting leasing, which I know we'll cover later in depth with some great data that Michelle has. So you can see in both San Diego and Phoenix, you can see that the weighted average built year for recent transactions signed exceeds the average built year of the overall market for tenants in place. So this sort of shows the demand for pace of new construction, both of these markets, is impacting leasing. So next, here are some stats that put the cost of occupancy in perspective in these markets. So for transactions that are closing for 100,000 square feet or larger, and by the way, we've seen a trend towards larger and larger transactions in each of these markets, you can see that the average annual cost for a lease has risen substantially across these markets, but is still more affordable than a market like Los Angeles, Inland Empire, which is a neighboring West Coast market, which is the most expensive in the nation. The growth there has outpaced these other markets, Phoenix, Las Vegas, and San Diego, since 2019. So for example, the average cost of a 100,000 square foot plus transaction in LA is more than 2.1 times the average cost of one in Phoenix, or 1.2 times the cost in San Diego, according to CompStak's recent data on transactions. So going back to the demand for larger and larger spaces, we've seen there's demand for supersized spaces, though this may be moderating recently with a slight pullback in demand in 2023 due to rising interest rates. So this demand for large industrial footprints came especially from e-commerce and logistics users that needed larger and larger spaces to fulfill their needs. So you can see in these charts for the buildings that have been built in 2000 or after 2000, the average transaction size increased 30% from 2018 in Phoenix. For Las Vegas, for buildings built in 2010, there was 122% growth in transaction size during the same period. So that covers what's happening with leasing and product that's existing and soon to deliver. But I think there's a lot more to dig into in terms of new construction and what has begun construction in these areas. Michelle, what are we seeing in terms of new construction trends in these Southwest industrial markets? Who are the major occupiers and what are the major, most well-known projects?
Yeah, thanks, Allie. So the active industrial construction in Las Vegas and Anderson County looks as such. So in Q2 of this year in Southern Nevada, which is the Las Vegas region, they added 3.2 million square feet of inventory, with the majority pre-leased at completion. So during the same period, net absorption equated to 3.1 million square feet. And the market's driven primarily by e-commerce and the need for more logistics space. So this is perfect. Tons of available dirt, land for this expansion. Smith's Food and Drug Stores, Interchange LLC, and Hey Dude, Good to Go shoe manufacturer are the three largest lease transactions in 2023 in Q2. And this is ranging from 313 to 480,000 square feet. So this map, we're showing the supply and demand and the active industrial developments here in the Phoenix metro area. So definitely the numbers, they vary depending on the source, but year to date, approximately the Phoenix metro region saw an estimated 48 million square feet of industrial space under construction. And that's roughly 12% of the existing inventory. And this ranks number 2 in the supply pipeline in the country, just behind Dallas-Fort Worth. And post-secondary institutions are also benefiting from this growth. They consider new educational programs and partnerships to better align with the current and future employment opportunities of these areas. And so along the 303 corridor, which is highlighted in red from the western part of the metro area, the notable employers in this area include Amazon, FedEx, REI, Walmart, Boeing, Pepsi, TSMC, the infamous development that's just to the north of the 303. And so in Q2, some of the major tenants who sign leases include medical uniform company Figs for 488 plus thousand square feet. That's over in Glendale. A third-party logistics from CG Logistics for 331 plus thousand square feet. That's at Commerce at the 303 in Glendale as well. ExxonMobil, also over in Buckeye, the western region, and Tempur-Pedic up in Tolleson for 321,000 square feet. So a lot going on in these areas. So next, Allie, you're going to show us some CompStak data focusing on the individual submarkets, I believe. So excited to hear about those.
Thanks, Michelle. So I'm not a market expert on Phoenix, Michelle is, and so it's been really interesting to learn about how hot that market is and everything that's been going on there. So here we're looking at the 303 corridor, since Michelle just covered all of the new development that's going on there. And how many new projects there are. So here we can see that according to CompStak's data, the northern part of the 303 corridor, which includes CompStak submarkets of Arrowhead and Deer Valley, actually showed faster rent growth than the rest of Phoenix and the southern part of the 303 corridor. It will be interesting to see what happens as more of the projects Michelle just covered lease up and how that affects rent growth and transaction trends. So next we'll cover San Diego in a little bit more depth, and where are the areas of most new construction happening there, Michelle?
Yeah, thanks, Sally. So although the industrial sector in this region is softening a bit, construction remains steady. So that's particularly in the Otay Mesa area. And the Otay Mesa neighborhood in San Diego has become a booming industrial region. It just sits north of the US-Mexico border, and it's the largest commercial crossing along the California-Mexico border. and the US-Mexico Canadian agreement that offers tax benefits to American and Canadian companies that outsource production to Mexico in place of the Asian Rim nations. And so because of this, it's led to an increase in demand for border properties, definitely in this area. And rents are still relatively inexpensive. There are large amounts of land available for development. And currently, we're already seeing 2 million of square feet under construction. So this is a hot spot in southern San Diego that's really booming. We see over here to the right the large projects under construction, a heritage industrial campus, and the Otay Business Park. You're looking at, millions of square feet, which is great for this area. So excited to see what's going to happen with that. And so what is CompStak seeing in regards to rent in this new area of construction in southern San Diego, Allie?
So yes, we call that area South San Diego, very aptly named, that area that is adjacent to the border, which is, as you say, has become a very important area for U.S. industrial development because of everything that's also happening in Mexico, which has been identified as a lower cost area to do business. So if we zero in on the southern San Diego market, CompStak's data shows faster starting rent growth than the rest of San Diego. It increased nearly 70% since 2019 as compared to roughly 40% growth in the rest of the market, which obviously is still double-digit growth. So again, these are rents that are covering the base rent of closed transactions during this time period for industrial space.
So now we're going to focus on highlighting the manufacturing in the Phoenix, Vegas, San Diego area. So what's been happening with the manufacturing sector in these markets and where is it growing fastest? That's what we're going to focus on now.
Yeah, I'm excited to talk about this. I think the growth of manufacturing is one of the most interesting trends, impacting our economy as well as the industrial sector. And I love looking at employment data. I know we've talked a lot about this, Michelle. So if you look at employment data for manufacturing, it reveals some interesting trends for these markets that we're focusing on. So we chose to look at what has happened since February 2020, which is right before the pandemic. So you can see that since February 2020, the Phoenix metro region has expanded manufacturing by more than 9%. This outpaces the rate of change for manufacturing jobs in the United States overall. And Phoenix's metro area actually added more manufacturing jobs than the entire state of California, which I found pretty interesting. And also Las Vegas's region, a little bit surprising to me, also experienced really strong growth. It also outpaced the United States overall and expanded a bit more than Phoenix with an expansion of 15.2% over this period. So manufacturing is still a diverse sector. There's many different parts of manufacturing. What are the specific areas of growth within manufacturing, especially it applies to Arizona and Phoenix?
Yeah, so some of the major industries are semiconductors, solar, aerospace, defense, battery, transportation equipment. So while we reshore manufacturing businesses, we start to see a supply chain challenge for skilled and the tech workforce to build and run these companies and industries. But there's an incentive for continued migration of skilled workers to Arizona, both from out of state as well as employees migrating daily from neighboring Mexican bordering towns. So the companies that purchase the machinery and equipment used directly in manufacturing here in Arizona are exempt from paying sales tax. Also, businesses that are principally engaged in manufacturing are exempt from paying sales tax on the purchase of electricity or natural gas. And so I'll talk here to the chart to the left. So regarding the solar industry in particular, Arizona ranks 6th nationwide. And in 2022, Arizona was ranked as the nation's 4th highest employment growth in the sector. So out of these jobs, about 2,500 filled solar manufacturing positions. And domestic renewables and the green transition have skyrocketed, especially here in Arizona. And the World Energy Outlook projects clean tech energy to surpass the oil market by 2040. So after looking at the manufacturing employment, how does this show up as far as leasing deals?
Yeah, thanks, Michelle. That's really interesting stuff. So we see some synergy when we look at CompStak's most valuable leasing deals that have been completed in Phoenix since the beginning of 2022. So most valuable to CompStak means the total rent to be collected over the life of a lease. And that's how we're defining most valuable here. So if we look at among the top 20 deals, that have been completed in Phoenix since 2022, you see that manufacturing accounted for the largest share of these deals by total value. And so some of these deals that ranked fairly high were Corning, JA Solar, which is solar manufacturing, as we spoke about, Michelle, Virgin Galactic, and Unicol Aviation. So also several of these top manufacturing deals were in the 303 corridor, which we covered earlier as one of the most active areas of new construction. So these were the deals from JA Solar, Unicol Aviation, and Axon Enterprise.
So what's next for the Southwest industrial headwinds and tailwinds? So let's end on what we think are some major trends to watch and headwinds or tailwinds for the industrial sector in the Southwest look for. So Allie, why don't you tell us a little bit about that?
Sure. So I think one of the most interesting trends, which is perhaps not a trend for all of the nation, but for some parts of the nation, as industrial development has become so robust, the demand for it, and there's fewer plots of land. Also, there's been pushback in some communities for sprawling developments. There's been an increase in multi-story development, though it's still sort of a small niche trend. So multi-story industrial development means sort of literally industrial development that's more than one story. It allows you to build more densely. But multi-story development requires multi-story rents, meaning rents are estimated to need to pencil in double digits for even a project like that to make sense. So for now, the capital of multi-story industrial development, perhaps not surprisingly, is in New York City. And there's a lot of multi-story development happening here. But there have been projects in Seattle, Chicago, and a few other places. So I feel like this is a strong trend to watch. You can see here on this slide where some markets have double-digit rents. Phoenix and Las Vegas are not quite there yet, and they have some significant amount of land left to develop. But San Diego might be a market in the future where multi-story development might be in demand.
That's super fascinating. Thanks, Allie. So the rising interest rates and the impact on new construction and supply are as follows. So you can see on this chart, the spike in interest rates beginning back in March of 2022 took a hit on the construction industry as a whole. So this caused funding challenges, like greater out-of-pocket expense for contractors, which led to a reduction in projects. And then, of course, lenders focusing on asset management, second-guessing contracts, and project profitability. But here in Arizona, during Q1 to Q3 of this year compared to last year, this is according to Arizona Business Exchange, construction here was a bit sluggish, and it was running short of 15 million square feet, about 2.2 billion in valuation. But looking at the projects projected to start in Q4 of this year, what we know of as of now, 2023 will round out at about 71.4 million square feet, maybe even more, because again, this is just data at this moment. Which is about 11.6 billion in valuation. So it's 17 million more and 3.6 billion more than all of 2022. So yeah, there was stabilization, softening, but overall, Arizona is not slowing down anytime soon.
Yeah, that's very interesting to see, what will happen with continued construction and how that may impact future, demand and supply.
Yeah, absolutely. So now we'll talk about nearshoring and manufacturing expansion into Mexico. So here we have the map on the left, and it's showing the different ports of entry. Particularly here would be the truck crossings, symbolize the amount of entries per port. And so the companies will continue to look to expand here in the Southwest due to shorter shipping times, the connectivity, as was mentioned earlier, and land availability, and of course, reasonable cost of living and the population growth, which go hand in hand. So we'll see companies continue to move and expand in Arizona, especially as the world starts to deglobalize trade. Arizona is absolutely benefiting from its proximity to Mexico, primarily in manufacturing. And the Arizona Corporation Commission worked with companies that have committed to creating nearly 25,000 new jobs, and the majority of those are in manufacturing. So Arizona stands to benefit greatly from these nearshoring trends. 3 NAI Horizon industrial specialists here at this office, Jeffrey Garza Walker and Lane and Cole Neville, they introduced to the market a new 215-acre warehouse and distribution center and light manufacturing industrial park down south near the border in Nogales, Arizona. And the first phase is on 43 acres, designed to accommodate 700,000 square feet of industrial facilities. The point of entry in Nogales, in that area, it's critical for that cross-border trade and the just-in-time supply chain manufacturing. And so this international border city is under 3 hours to Phoenix, 8 hours to LA, a little more than 5 hours to El Paso. And the nearshoring and e-commerce, their vitalizing expansion in San Diego will continue to see more offshoring and nearshoring with the bordering towns like southern San Diego's Otay Mesa neighborhood, Nogales, Arizona. This is going to be booming with development, what we've already seen. And this is due to Mexico's tertiary markets expanding towards the US-Mexico border. And one of the most dynamic Mexican market is in Tijuana, which is adjacent to San Diego's Otay Mesa neighborhood. And that neighborhood port handled $60 billion in trade volume over the 12 months ending in January 2023. And that's up 10.5% year over year. So Mexico continues to grow in the industrial sector. And large companies like Tesla and Quanta, which is the computer company that supplies Tesla, they're investing heavily in the Mexican cities. So similar to, I guess, Nuevo Leon and other bordering areas. And the closer to the Arizona border in Nogales, you can see companies like Charles Industries expanding in its size. That company in particular is a manufacturing company and it supports the telecom and utilities market. And back over in Tijuana, Brentwood is a medical packaging company. It's also expanded in size to meet the demand in that area. So there's a lot of exciting movement happening across the bordering region, and we anticipate much more to come. And I'm super excited to see how that grows and develops here in our office.
Perfect. So I do have two questions if you have a few minutes just to go through those. So one chat I received was, based on past and current project developments, where do you think future industrial development will expand in Phoenix?
Yeah. Okay. So overall, the growth will most likely continue along the major freeways and highways, like I had mentioned, in those thoroughfares, and expand outward from the Phoenix metro area. That's where the land is available. Land's relatively inexpensive, but the client's needs will continue to trump the next hotspot, if you will. So like labor, including the availability, competition, surrounding companies, as well as the cost. And of course, utilities like power and water, they're all important factors to consider. But all that comes hand in hand with population growth, subdivision development. It all just kind of ties together. So that's where I see things happening.
Allie, did you have anything to add to that one?
Yeah, I think it's really interesting for the markets, especially Phoenix. Kind of the two major markets that it's next to, Mexico and LA, are kind of a major tailwind for the market, for kind of differing reasons. LA, because it will probably remain more expensive. So for any, especially East Coast users that are looking for a West Coast presence, I think they'll continue to look to areas like Phoenix and Las Vegas. And then with everything that's happening in Mexico, if you need a US, across the border place to occupy, I think Phoenix makes a lot of sense because of all the connectivity and reasons that Michelle outlined.
Perfect. And then the final question I received was, are there any indications that the industrial market is softening?
Yeah, that is an interesting question. And I know a lot of people are thinking about that now because the industrial sector has been sort of the darling of, post-pandemic, and people have looked to it for investment, especially as other sectors like office and multifamily have kind of been waning over the last year or so. So there are some indicators that it's softening a little bit, but more returning to pre-pandemic norms in some markets. So, for example, across 10 major markets that CompStak tracks, which include the markets we talked about today, we've been looking at concessions. So concessions are traditionally less of a factor in industrial deals, but the average free rent period awarded to industrial deals is actually up slightly from 2022 levels this year. So that indicates that maybe there's slightly more bargaining advantage on the side of the tenant. So for example, across these major markets, the average free rent period accounts for 2.0% of the term in 2023. And that is up after declining for the past 2 years. And that's now on par with 2019 levels. And we've also been looking at, average transaction size. We covered earlier in this presentation how much that's driving the need for any new construction that's been started over the past few years and how it's increased in these markets from 2019. But we've seen that the average has actually come down a little bit from 2022 as for renewals as well as new deals. But it's dropped most for new deals as well as deals in Class A space the most. So this indicates that maybe users are taking less space, and also they may be looking to Class B space in a drive for affordability as prices have gone up. But I think the rest of 2023 and early 2024 will give us, more color on the issue, especially as we continue to pay attention to what the Federal Reserve is doing, and if there's going to be, additional rate hikes and how that will impact the market.
Fascinating. Thank you both for your time. And, Allie, Michelle, this is fantastic.